Thank you so much for having both of us. It's been fun to get to know Luke over the last few weeks. And before we jump into Pipe, I found it really interesting for myself, and I'm sure for many people here, to just kind of learn a little bit about your journey from Intuit to here, and how that all came together. And then I think we can go a couple levels deeper about Pipe.
Okay. So I have sort of a unique career where I spent, it's like two phases, right? The first phase was all distressed special situations credit. And the second half was all like fintech product design type stuff to building products for small businesses mainly. And so prior to Pipe, I've been at Pipe 2.5 months, and so very new in the CEO role here. But prior to Pipe, I was at Square, so I led Square Banking. It was the products were Square Loans, Square Checking and Debit Card, Instant Transfer, and Square Savings, and we were in 4 geographies. So that was one of the largest kind of at-scale alternative lending businesses in the world. I was only there 18 months before I took the Pipe role. But before that, I was at Intuit for 5 years. Intuit's a pretty amazing place for like leadership training and customer-facing design. So you have guys like Brad Smith, who can stand up and motivate 8,000 people with mission-based leadership and talking about the customers. And then you look at Scott Cook, who's been there since he founded the thing in 1984. I love these old stories. That Intuit's really good at storytelling, but Scott and his founding partner wrote the first version of Quicken in Pascal for the DOS operating system. So that's how long they've been out doing it. But the other thing Intuit was really good at was customer-facing research. Scott Cook would literally go to watch people in a store buy shrink-wrapped versions of Quicken back in the day and say, hey, can I actually come watch you install this on your computer? Can I follow you home? And so it's that DNA of understanding what your customers need and watching that customer experience. So Intuit's really good at those things. Square was fantastic at product velocity, like teams that can just build, sprint teams that can build new products fast. So having that kind of combination of product experience was fantastic. But I spent a decade before that. I was at Sixth Street Partners, was part of TPG Capital at the time, just buying lots of bad loans from banks through the crisis. So I'd seen all types of every kind of loan you can imagine, every type of cash flow stream you can imagine. So it's just you go out and you look at all these competing lenders out there, and the way I tell the story is that they usually either understand technology and how to build technology, or they understand credit. There's very few that can do both.
Yeah, and I think it's a great segue. For everyone in this room, fintech. I was talking to somebody on my team. He said there was twice as many people last year, and everything was buzzing around fintech. And I think this year everyone's questioning fintech. And fintech's complicated because you might be able to have a customer acquisition advantage or an underwriting advantage. But I think people are realizing if you don't have multiple things in place, there's a lot of cracks in the model. So one of the things we talked about is through your experience being an advisor at NICA and just through kind of seeing different evolutions of fintech, which is a lot of times what's new is old. What are the things that you've observed that are, I think you said there's top 5, but what are the things that if you don't have in place, you're just not going to be successful? And I think that then there's going to be a lot of have and have nots then kind of in this industry moving forward, which may not be a bad thing.
Yeah, sure. I've always broken it down into 5, and I think guys like Ken Lim, the Credit Karma CEO and founder, has a similar framework as well. So it's not new. It's not something unique that I came up with, but it's right. So there's 5 things you need if you're going to be a successful specialty finance company is what I would describe, because these companies have been around for hundreds of years. Adding technology to it is the only thing that's changing, but the themes are the same. And I'll go through the list of the 5 things. Number 1, you have to be able to acquire customers in a way that is cheap enough to make sense. Right? You have to be able to recruit them because your product is good, or figure out the right marketing, figure out the right channel partners. You have to be able to acquire customers in a way that's relatively cheap. Number 2, you need a data set, a consistent, standardized data set to actually underwrite. And on the consumer side, that can be easy because FICO score is homogenous. On the small business side, that can be very challenging because there's nothing harder than just categorizing small business transaction data and knowing that you actually have all of it. So 1, customer acquisition. 2, having a data set that's standardized to underwrite. Number 3, you have to have a credit policy that works. Battle tested through the cycle credit policy that is going to work on that same standardized data set. So you can have all the data, but if you don't know how to get paid back, it's a real problem, right? And so 4th then, is basically like basic operational flow. Like the unit economics of the business have to make sense. The losses that you're generating from before and the operations and the cost of acquisition, like everything has to make sense from just a margin perspective. Like will the unit economics of the business make sense? Are your operational costs low enough to make this all work? And then the last one is actually the most important that a lot of people, which is what really craters most, especially finance companies through the cycle, which is in order to make loans, you have to have money. That's capital markets. Like you have to have a way to raise money and lend money, and if you can't, nothing works. And you can't do the fifth thing unless you have all of the first four things, especially through cycle. And so when you're looking or talking to any lender out there, like if you use this framework, and like you need to make sure that they check every single box, or they will be one of the ones that is not going to make it through the next cycle. You have to be battle tested, all this stuff, and if you can't get it all together in the right way, it's just the businesses won't work.
I think that makes a lot of sense. Even when we started Upper 90 in 2018, there's a lot of VCs out there that can help with hiring and marketing and sales. And when we felt the missing gap was a lot of these fintechs or specialty finance companies need that first facility. They need help hiring the first risk manager. They need help figuring out capital markets. And often those end up being like second or third phase things. And it kind of goes back if you don't do them in the beginning and that's core to your business. And so that's kind of where we wanted to fit. So one of the things that for a lot of people in this room may stand out is when you think of pipe, you often associate it with RBF. And within RBF, we think of CapChase and Wayflyer and Clearco. And as you know, we've always thought of, RBF has existed offline, it's existed online. One of the things through our discussions was how you look at your competitive landscape and how you would define it. And I think it might be different than how a lot of people might associate you with the RBF space today.
Sure, like revenue-based finance is a broader category, I think, than most people think, right? Like if you look at the big lenders now, like, and I'll put Square Loans in the category, like Stripe Capital, Square Loans or Square Capital, and PayPal Working Capital. That is revenue-based financing. Like you are securing against future merchant revenue streams. Factoring. That is also revenue-based financing because you are going to the payer of the invoice, like locking yourself down to that specific revenue stream tied to one invoice. There's a whole the whole generation below that. So those are the two that are actually I would call secured revenue-based financing. You're either securing against the cash flow to get to unit economics and risk that makes sense, or you're securing directly against the payer. So the payer, if Lockheed Martin is paying the invoice, you have to physically notify them with a letter that they need to pay you instead. So you get direct security in those two forms of revenue-based finance. And those have been around for hundreds of years, right? And there's nothing new to that. Like the reason why they work and they're battle tested like that is because they have some form of security. All the newer versions of revenue-based financing, for me, it's just too risky from a unit economics perspective because venture debt works great if VC money is flowing, right? If you're trying to secure against different revenue streams through different things, if you're not actually you're not actually in the flow of the money from a merchant finance perspective, or if you're not actually getting paid by the payer yourself, that's where the risk starts to fall apart, right? And so if you think about the battle-tested revenue-based financing that's happened throughout, frankly, the last 50 or 100 years here, merchant cash advance or merchant finance and factoring are two of the largest ones. But it's because they're secured against the cash flows, right? And that's what works better.
I think it kind of ties back to the point we just talked about, what are the ingredients you need to be successful? So we, as Upper 90, we've looked at a lot of different companies that maybe had one or two or three of those five. So there was a company we saw called Jaris, and they said, hey, we've solved customer acquisition because WorldPay has all the customers, and now we're just going to go and embed finance, and that works. And it's not that simple. So when you kind of take a step back and look at, there's Paraffin doing it with DoorDash, and there's, everyone's trying to find some ARB. How do you kind of see this industry shaking out a little bit?
I mean, I don't want to talk about any of our competitors, but going back to the either understands technology or understands credit, all of those names you can go back through and say, okay, they're really good at tech, but maybe not so great on the capital market side, or they're really good at the capital market side, not so great at tech. You can't go to a WorldPay, if you want to use that example, and say, hey, we've got this credit policy model that works, let's go. but like, well, what do your APIs look like? And if you don't have Stripe Stripe quality APIs, then the modern technology, like the engineering team that is making that decision on should we go with this partner or not, is going to say we can't go with them. Their APIs are crap, right? And so you have to just nail it on both sides, and that's really, really hard to do. And so, like, whoever out of the gate can do both the right way and start landing those channel partners, because nobody's been able to do it yet, right? Like, and whoever's out of the gate and can do that is the one that's going to win, right?
And like over we did this 2 or 3 years ago, this chat, capital markets would have been kind of a known, if you do both of those, there's money.
Right.
You know, like when we did a loan, it wasn't like when you were going to be refinanced, it was who.
Right.
And so like now, how do you think about capital markets and like moving to more asset light and getting access to meaningful capital? Like what's changed, or is it still available?
This is just the credit cycle. Like my whole career was driven by the credit cycle. Like I got out of grad school, like went into investing right before the the global financial crisis exploded, and like ended up as a distressed investor my whole career. Like it's just going to happen like clockwork. Every 8 to 10 years, there's going to be a real problem where money pulls back. And you have to be prepared for when that happens. And so when you go back to the risk concept that I described, like you really cannot scale a specialty finance company unless it is balance sheet light, right? That's one of like Hans Morris at Nike, like one of his main criteria for if he's ever going to invest in another lender again, it absolutely has to be balance sheet light. And the math is simple. If you're balance sheet light, it means that you can sell whole loans, right? In order to sell whole loans, the risk has to be perfect. And for the risk to be perfect, you've got to be in the flow of the money, right? And so with I'll just give the math example. With $4 million of balance sheet capital, if you're selling whole loans every single business day, you can deploy $1 billion a year in loan volume, right? And if you can earn 6% on average on that billion, that's $60 million of revenue. So with $4 million of balance sheet, you can do $60 million in revenue. If you go back to like a 90% advance rate facility, if you deploy $100 of loans, you have to put $10 of equity in it. And you're probably going to make at most $10 of revenue on that loan. So you are dollar for dollar. For every dollar of revenue growth, you need to put $1 of equity in. Those businesses will never scale. It's just not possible unless you have unlimited capital or you're a bank with deposits that you can just leverage and use. And so if you're a non-bank alternative lender, you will not scale. I'll just say it, you cannot scale, like in good times or bad, without being more balance sheet light, which means sell whole loans, which means you've got to have a risk that makes sense, that's battle tested. So all this RBF that's happening, if it's not a battle tested version, I don't think it works.
And what advice for founders in this room or for people starting their own fintech or lending business? It takes some steps to get to whole loans and to get a big enough pool. Like, how do you kind of think about the steps a founder or startup should take to, you know, kind of do that phase one where, you know, you can't just use equity? How do you think about like that sequence?
So we did this at Intuit, right, where you go and if you have to find money is the answer, right? And so you either get the venture capitalists to give you a bunch of equity dollars to start testing with, and you probably have to start with a 90% advance rate facility or a 75% advance rate facility where you're taking most of the first loss credit risk. And so in order to actually start a lending business, you probably need 50 to 100 million of capital just to deploy into lending. And you need another 50 or 100 to actually hire a bunch of amazing like engineers and product people to go build the technology part of this. And so where we're at right now in the cycle, that is just not possible. Right, so you have to either have already raised it or have a parent company that is willing to take the bet and invest in it. And so that part of the reason why I joined Pipe is because we have 5 years of runway and we have an 85-person team. And so because we have exactly those components now and have the capital to go do it, you need 4 or 5 like vintages completed to then go convince somebody on the capital market side to buy these loans. And so it's going to be a staged rollout where we have a 90% advance rate facility now. We're lucky enough to have a ton of cash still, and so we'll use that to scale and do the first 4 or 5 or 6 vintages. And over a 9 to 12 to 18 month period, you get enough historical data to then show the deep whole loan buyers on the in the flow of money RBF stuff. All the people that are buying from Square right now, yeah. If the risk looks like that, they're going to buy, right? And even in a market like this, because that is really good risk and it's idiosyncratic from anything on the consumer side, which is having a lot of trouble right now.
It's an interesting point because when we see some portfolio companies in fintech, like 2 years ago, you could raise $5 million raise, a $25 by $50 million credit facility, and I think everyone's now like, you need to have a better leverage ratio, and that kind of signals that there's a lot of headwinds still for fintech generally, because if capital markets are tight and companies actually need more money, it kind of feels like we've seen this in other industries, like the bigger are going to get bigger and it's going to be harder to start. And one question I asked Luke is like, if you had to buy a business, what would you buy? He's like, I wouldn't buy another lender, I'd buy more of a distribution partner. So with all of this, like, how does it help us, for everyone here, go back to the first question of your journey, how does this all tie together back to Pipe? With Luke's background, I asked him, hey, would you start a business yourself? And you were very excited about kind of all these pieces fitting together here. So tell us about, what's different for Pipe moving forward. What are your major changes, your goals? And just for everyone in this room, how they should think about, the next couple of years for you versus the industry.
Sure. I mean, like, the reason why Pipe made sense now for me is that I've actually always wanted to do a startup. And it would not be possible for me to go try to raise 10, 20, 30 million dollars to go build something in the small business fintech risk space, right? So when the Pipe opportunity came along, I was like, well, let's just look at all the things that are here. Like, do we have the necessary main components to actually go build the thing that I'm pretty confident is going to work? And the answer was just yes, over and over again. And so to have an 85-person team and 5 years of runway, like one of the, I guess, what interesting thing here, like one of the first things I did coming in was to just say no to so much stuff and let the team focus. So we said no to the UK business, we're selling our entertainment business, we said no to the sports business, we withdrew our broker-dealer application. There's just so many things that the team, a bunch of amazingly smart like engineers and people trying to go build, but they're trying to do 12 things at once. And so we just narrowed the focus. You put in place the normal frameworks that you use, like rapid decision framework or SPADE, like Gokul used at Square. The basic stuff. Set the squads or sprint teams up in a way that works so well at Square. Make it work. Lead with the same type of like mission-based culture and leadership that Brad Smith does at Intuit. Use Scott Cook's customer-facing research and design DNA to like put all these pieces together to go build something amazing. But I spent still now, like even this week and next, I have 5 or 6 slots, 20 minutes each on my calendar every single day to meet all 85 employees of Pipe. So I've gone through and talked to about 70 of them so far, just to like start to build the web, like living in a remote world. Like,
is there something that just surprised you, good or bad, from your first few months?
The founders were able to raise $316 million with an amazing vision and story and idea. That like press and like brand that was built from that attracted some of the most amazing talent, right? And that talent is still here, right? There was a lack of focus that caused things to not get built, but the biggest surprise to me was how amazing the team was. Like better than better than my team at Square. I'll just say it. Like the engineers are amazing. We have a bunch of ex-Stripe and ex-Plaid engineers on the team that came because they wanted to be part of this new big amazing thing, and to have that framework of people that just need to have the right vision to get excited about and the right customers to want to go help, and like give them the basic frameworks to then line it all out and head in the right direction. That was the biggest aha surprise for me. Is like, wow, like we don't actually have to rebuild the team. Like I'm gonna hire a couple of more execs, but like everything else is great.
That's great. And we get this question a lot, from our investors. Inflation and consumer demand is weakening, and I still think the markets are huge. And how do you just what's the biggest challenge, or what's like the biggest hurdle that it feels like internally you have a good plan, and the asset light vision is something I found to be unique, where everyone's still kind of asset heavy, and it's going to be really challenging, I think, to grow out of that. But what do you think is the biggest thing out of your control right now?
The thing that keeps me up at night, I guess, is that at Intuit and at Square both, we just, going back to the 5 things, we had all the customers and we had all the data and we had credit models that we built over time. And so it's a crutch to just know that a customer's coming in every single week to QuickBooks to enter their accounting data and you can cross-sell them a loan. Same thing at Square. People are managing their payments business and their terminal, and they see a pre-approved loan offer. It's really easy. So for me, there's a bit of it, if you build it, they will come, happening right now. We are going to build a fully scalable business by Q4 of this year and go sell channel partners. And you have to trust that we're going to do this and then start scaling into 2024. That's how it's going to take us 4 to 6 months to build all the infrastructure to move forward and go. And so it's a bit of a chicken and egg. So for me, it's we have to execute. We have to nail it, and then we have to sign the channel partners and start scaling it. And so that's the part that makes me a little bit nervous. But I guess that part is in our control. The macro for me is, it doesn't matter. Like, this is where we are in the cycle, and starting a lending business now is actually an awesome time to do it, because coming out, you'll be the winner.
Right. Super helpful. Thank you so much.
That seems like a great note to end on. Our thanks to Luke Voiles from Pipe and also Billy Libby from Upper 90. Thanks so much.
Thank you.
Good stuff.